Hey everybody, I'm here to talk to you about the Fed's new ample reserve policy framework. Now I want you to understand that this is video 2 of a 3 or 4 video series. So if you don't understand everything I'm talking about in this video, please go back and look at video 1, the introduction. But this is video 2, and in this video, I'm going to focus on the demand for reserves curve, because that is the important curve to understand again, the Fed's new ample reserve policy framework. This is how they now implement monetary policy, is under this ample reserve framework. Before 2008, they had a limited reserve framework. Now they have a ample reserve framework. And again, the key here is under the ample reserve framework is to understand the demand for reserves curve. Now that's the blue line, but I want you to understand I'm very much drawing a conceptual version of this line. Really, this is the line we want to conceptually understand, this shape right here. And if we do, we've pretty much got it. Now I'm going to go into the weeds a little bit more in subsequent videos, but really, I kind of think this is probably going to be the key video that we want to understand. Now here's the deal. The demand for reserves curve, again, that's the blue line right there, is written in respect to the federal funds rate, okay? So it's a demand curve, right? And so when we say it's a demand curve, it's in respect to a price, right? It's quantity demanded in respect to a price. And what is that price? The federal funds rate, okay? Now here's the thing. On the vertical axis, I put a percent sign. Why did I put a percent sign and not the federal funds rate? Because we're actually going to see a bunch of interest rates associated with this vertical axis. But again, when we think of the line itself, the demand for reserves line, we want to think of it being written in respect to a specific interest rate, the federal funds rate. That's really key, okay? And basically, what is the federal funds rate? In regards to, as far as banks are concerned, it's the cost of reserves. Now, it's either an explicit cost or an implicit cost, which are both costs. Hopefully you kind of remember back to opportunity cost. When we think of opportunity cost, it's made up of 2 types of costs, explicit and implicit. Why is the federal funds rate perhaps an explicit cost? Well, for banks to get reserves, they have to go to the federal funds market, or will often go to the federal funds market and borrow reserves there and pay the federal funds rate. It would be an explicit cost in that situation. They'd have to actually make a cash outlay in that regard. They'd have to pay that federal funds rate. But again, it could be an implicit cost. It is the cost of them holding on to reserves, okay? Because they can go to the federal funds market, instead of demanding reserves, borrowing reserves, they could supply reserves. Remember, the federal funds market is an interbank lending market. It's where banks lend other banks reserves. So banks are both suppliers of reserves and demanders of reserves. And so again, the federal funds rate could be an implicit cost because, hey, if I hold on to reserves at the Fed and not lend them out, I am foregoing the federal funds rate. So no matter what, we want to think of the federal funds rate as a cost of holding on to reserves. And that's really what this curve, the demand for reserves curves, is all about, is their demand to hold reserves at the Fed, to hold on to reserve balances. Now, what you look at here is it's kind of an interesting shaped curve. I want you to see that there is kind of like this downward slope, which should make sense, right? It's a demand curve, and we've got a price of that asset, okay, or price of holding that asset, and so it should be inversely drawn. But it's got kind of a couple of distinct flat areas. What are those all about? Well, here's what I want you to understand. I want you to talk about a few different ways that we could think of this curve. If the Fed did not have a discount rate or pay interest on reserve balances, and I know you might not understand exactly what I'm saying right now, but and they didn't have a reserve requirement, in other words, the Fed didn't kind of use any of those monetary policy tools, discount rate, or interest on reserve balances, or reserve requirement, it would look like the B line. It would be a demand curve that we are quite used to. It would be just a downward sloping line. Now, you can see, hey, it's not going to be completely linear. I'm kind of drawing it so that it gets steeper and steeper as it gets closer to that vertical axis, because banks, no matter what, are going to need some reserves, right? So they would be willing to pay quite high federal funds rate, or forego quite high federal funds rate, to hold some level of reserve balances. No matter what, they're going to need them. But I just want to again say, hey, if there's no discount rate, no reserve requirement, no interest rate on reserve balances, it would look like that B curve, and it would look like this B curve. It would just be like that. That's what the curve would look like. So let me talk about this. And again, if you're a little bit lost right now, just stay with the video because I'm going to explain everything I'm talking about in just a little bit. So why would it go like this? Well, here's a critical element of this B curve, kind of right there. See how it kind of gets down to 0% federal funds rate? That's when we could say that reserves are ample. They are truly ample. They are enough. Banks have enough of them to do all the basic things they would like to do with them. In fact, the only reason they would hold reserves past this point right there is if they were paid to hold reserves. And that's when that interest rate on reserve balances is going to come into play. Interest rate on reserve balances, right? Interest on reserve balances, or what I like to call interest rate on reserve balances. Okay, that's going to come into play. But if there was no interest on reserve balances, that demand for reserve curves would eventually get all the way down here, meaning they wouldn't be willing to pay, or they wouldn't hold any reserve balances past here. Remember, they wouldn't pay any money for reserves, they wouldn't need them, and they wouldn't hold any reserve balances. They would go lend them out, right, at any positive federal funds rate. So it would actually get all the way down to here, and the key is right there, conceptually speaking, we want to think of, that kind of marks where now we are operating under an ample reserve framework. And so all we want to understand as far as the supply of reserves curve is it is somewhere over here. Notice I haven't even drawn it. I might draw it by the end of this video. But the supply of reserve curve, not very important at all anymore under the ample reserve framework, because the Fed does not change the supply of reserves to change their policy rate, which is the federal funds rate. Okay? I know it's confusing, but stick with me. All right, so hopefully we kind of understand the B curve. Again, that's if the Fed really just didn't have any administrative interest rates or administered interest rates, like the discount rate or the interest rate on reserve balances, or didn't even set a reserve requirement. Now, let's talk about the C curve. This one's really straightforward. The Fed used to set a required reserve ratio, okay? When they had a limited reserve framework and reserves were scarce, they said, hey, banks, there is a required amount of reserves you have to hold. Well, if they set a positive limited required reserve ratio, a positive required reserve ratio, then at that required reserve ratio, we would see the line get vertical. Basically, banks would be like, I've got to hold, no matter what the cost, I've got to hold that amount of reserves. But here's the deal. The Fed, in 2020, lowered the required reserve ratio to 0. That's right, under an ample reserve framework, they really don't need a required reserve ratio anymore, and so that is not the shape of the curve. What is the shape of the curve? It's flat like that. Why is it flat like that? Well, it flattens at the discount rate, okay? The discount rate, here's the important thing, it sets a ceiling, okay, for this demand for reserves curve, okay? It sets a ceiling. Now, I'm going to explain why that is in just a second, but I want y'all to take a look at that right there. It's on the far left. It sets this ceiling. It flattens out right there, and that discount rate is about 0.5 percentage point above the high end of the federal funds rate target range. And that's right. The federal funds rate is actually not a specific amount. It's a target range, usually 0.25 percentage points, okay? But that's also not conceptually important for this video for the understanding we want to get. So just think of the federal funds rate as being an amount, and the discount rate is about 0.5% more than that, okay? And it sets a ceiling on this curve. Why does it set a ceiling on this curve? Because banks are not willing to pay a higher federal funds rate. Remember, the demand for reserve curves is written in regards to the federal funds rate. They're not willing to pay a higher federal funds rate, let's get rid of this portion right there, than the discount rate for reserves. Now, truly, there's a little stigma about borrowing reserves from the Fed, so maybe they would pay a little bit of a premium. But again, we're staying conceptual, and so for the most part, they're not going to pay much of a premium, right? They're not going to pay much more to borrow from the federal funds market than they have to pay to just simply borrow from the Fed. So when the Fed sets the discount rate, it's setting a ceiling. No banks are going to be willing to borrow above that interest rate. They're not going to be willing to pay federal funds rate above the discount rate. So there we go. We finally got it, that flat portion, okay? Think of that as kind of what we might call range 1. I put A1. So the demand for reserve curve is this A line right there. Now, this portion right here, the steep portion, is important, and it was very important under the limited reserve framework, okay? Remember, under a limited reserve framework where reserves are scarce, you'll see this type of curve, okay? Basically, reserves are a need, and we might know from our microeconomics class that when something is a need, we're rather inelastic, and inelastic curves are drawn relatively steep, right? And so, hey, they were a need, it was a pretty steep thing, and in that situation, hey, the Fed could just simply manipulate the supply of reserves curve to change the federal funds rate. But this is no longer a very important range at all. A2 is not important because, again, we are not operating under a limited reserve framework anymore, okay? We are way out to the right. In that first video, I told you we are way, way, way to the right, right? My board's not big enough to kind of show the true demand for reserves curve because this flat portion is flat for many feet, yards going that way, right? And so, again, I kind of want you to think of right there, put kind of a break right there in the graph, okay? And just extend that line far to the right. And then if we go far to the right, hey, there's that supply of reserve curve. But again, that curve is not even important really anymore, okay? Again, we used open market operations to change where that curve was at, but it's no longer important because you can now shift it right and shift it left. And hey, the federal funds rate, not going to change hardly a lick under an ample reserve framework. So no longer very important. So how do we manipulate, or the Fed, how does the Fed manipulate the federal funds rate? It is with this interest rate on reserve balance, interest on reserve balances, okay? They pay interest on reserve balances. Now, technically, it's this interest rate and another one, a secondary policy tool known as the overnight reverse repurchase agreement rate. And I will explain that in a subsequent video. But again, it's not important for our conceptual understanding because their number one policy tool is this. And that's what we really want to understand, this interest rate on reserve balances. And so here's the deal. They pay interest on reserve balances. And so, hey, we're not going to hold zero, right? Reserve balances if we're getting paid money to hold reserve balances. And so wherever they set the interest rate on reserve balances, hey, that's where the demand for reserve curve is now going to flatten out. The interest rate on reserve balances sets a floor, right? It sets a floor for the demand for reserve curve. And this floor, this area right here, is kind of like the all-important portion of the demand for reserves curve because it's going to give us our federal funds rate, okay? So we set that interest on reserve balances to be 25%. That federal funds rate should move to about 25%, okay? For a couple of reasons. One is known that the interest rate on reserve balances is known as a reservation rate, and there's this arbitrage aspect to that rate. But it almost, just without even knowing those two terms, is kind of intuitive, right? Hey, if I set the interest rate on reserve balances, hey, my demand for reserve curve is not going to go right down into the horizontal axis. It's going to extend out because I'm going to get paid that amount. And so now they change this to change that. Now, those two things I said, reservation rate and that arbitrage aspect of why these stay aligned, I'm going to explain in a subsequent video. But for right now, in this video too, here's the big thing. The Fed wants to raise the interest rate, right? We're in 2022, we're fighting inflation. I want to raise interest rates in the economy. So what do I want to do? I want to raise my policy rate, my benchmark interest rate, the federal funds rate, right? That's what the federal funds rate is, their benchmark rate, their policy rate. I want to raise it up. Well, how am I going to raise it up? I'm going to raise the interest rate on reserve balances. And when I do that, that curve is going to move upward, right? It was about right there. and we're going to move that upward. And when we do that, since we like that discount rate to be about a 0.5 percentage point above the federal funds rate, we will also raise that up, right? We will raise that discount rate. So we raise the discount rate and the interest rate on reserve balances by whatever we want to, 1/4 point, 1/2 point, 3/4 point, full point, whatever. And when we do that, where that demand for reserves curve intersects that supply of reserves curve, that is our new federal funds rate, and that should transmit into the rest of the economy, both short-term rates and long-term rates. Okay, again, this video too, I think, is so important. And it is so important for you to understand, really understanding the demand for reserves curve is now the real key element to understanding how the Fed implements monetary policy, okay? And what they do is they basically adjust the ceiling and the floor with their discount rate and interest rate on reserve balances, and that's how they change the federal funds rate. And if you don't fully understand yet, I understand. Stay tuned. We got more videos coming your way. Thanks for tuning in.